Hello?
Eric. Eric. Eric, how are you? Eric is not here. Philip, how are you?
I'm fine.
Okay. I know that you have to be fine.
So,
I hope you are all doing well. All right. So I have about how many people do I have here? 1, 2, 3, 4, 5, 6, 7, 8. Only 7 people. Okay. That is not bad. All right. So let's get started. You see, because of the structure of the examination or the syllabus, so I have divided the meeting into 2 equal parts. In the morning like this, we'll be looking at maybe consolidated financial statements, maybe sometimes final accounts, but the final accounts depends on the standards. So in the evening, we'll be doing the standards. But today we are going to do ratio analysis. Today we are going to do ratio analysis in the evening. But any of the evening will be standards from next week. So today I'm hoping that we should finish the ratio analysis by maybe by the close of the meeting, we should finish the ratio analysis. But next week in the evening, we are going to do standards. So we'll be doing the standards in the evening and be doing the consolidated financial statement in the morning. If you are done with the consolidated financial statement, then we'll be like, maybe we'll be far gone with the standards. Then we start the final account in the morning. So maybe by June, you should be able to finish everything. The standards I'm thinking about, we finishing like 10 standards, 10 standards. So if you have 10 standards, then you are good to go. So this morning, I want us to look at a consolidated financial statement. Consolidated financial statement. If we are talking about consolidated financial statement, we are saying that you preparing financial statement for more than one entity. More than one entity. So if you're preparing an account for only one entity, then it is the final account or the published account. But if you're preparing financial statement for more than an entity, we say that that is consolidated financial statement. It is, we say consolidated financial statement because it's a relationship between one company who we call the investor and another company who we call the investee. When do we prepare for a consolidated financial statement? It is where there is a relationship between a parent, or there is a parent and subsidiary relationship. Who then do we call the parents? The parent is the investor and the subsidiary is the investee. So if you have a company and maybe you want to expand to another region or another country, you have a company in Accra, but you want to expand to Kumasi, and you don't have all the resources it takes to do the expansion by your own, like going there to set up your own business, going there to set up your own company there. You don't have the resources, but you have an entity already or a company already, which is already operating in the industry that you're operating. You can just go there and buy that particular company. If you buy that particular company, we are talking about the ownership. What is the percentage shareholding? What is your percentage shareholding in that particular company? If you have more than 50%, then we are saying that you have a control over that particular company. If you have less than 50%, but more than 20%, we are saying that you can call that particular company as an associate. You can call it an associate. But if you have less than 20%, then you have to account for your shareholding in accordance with financial instrument, IFRS 9. So that is basically what we talk about, consolidated financial statement. Consolidated financial statement exists when there is a parent and subsidiary relationship. When an investor has more than 50% of its shareholding in the investee, that is only when you can prepare consolidated financial statement. If you don't have more than 50% shareholding over that particular company, you can add that particular company's asset to your own. So you can prepare consolidated financial statement. So we only prepare consolidated financial statement when you have a control over the investee. When you have a control
Hello?
over, yes.
Hello.
Yeah, Eric, I can hear you. Eric, I can hear you.
Hello.
Eric, I can hear you. I can hear you, Eric.
Hello.
Eric, I can hear you very well. Are you testing the mic or what? Eric, I can hear you. Eric, can you hear me?
Hello.
Eric, I can hear you. Eric, I can hear you very well.
Hello, sir.
Yeah.
I'm sorry that what you are saying, for instance,
Okay.
let's say I own MTN company,
Okay.
then maybe I have a branch in another place like Swedru.
Okay.
The investee, is it the person who has also invested in the branch, or in like your other branch? Like maybe they have also bought some shares.
Did you set up the branch yourself in the Suedo?
Yes, if I put down the branch myself.
That is you can prepare the account together, but that is not consolidated financial statement. It is the same company within you. That is what we call internal development. But we are talking about
Okay.
situation where you have MTN, but you want to expand. So you want to buy Vodafone.
Okay.
Or you want to expand, then you go and buy another networking company in somewhere. Or you want to expand,
Okay.
then you go to Togo and buy TogoCell. So TogoCell will prepare its own financial statements, and you also prepare your own. But you come and prepare your own as a group. You prepare for the two as a group because
So
the two companies are the same. Yeah.
Okay, so meaning when you buy the different this thing, you get people to also invest in it, or
No, if you are buying it, if you are buying the different company, we assume that the shareholders of MTN are the ones buying the TogoCell or Vodafone.
Oh, okay.
Are you getting it? So it's not like you, the individual, you are going to buy. If you, the individual, you have the capacity to go and buy, we don't have any problem with that one. But if MTN is buying of Vodafone or buying 70% of the shares of Vodafone, we assume that it is the shareholders of MTN that is buying off the 70% of the Vodafone.
Okay.
All right.
Okay.
But on this note, I can tell you that the consolidated financial statement that they taught you at University of Education, Winneba Kumasi campus is bogus. It's bogus. So
okay.
yes, I also learned the same thing. So it's bogus. So you are coming to learn a proper group accounts. All right.
Okay,
so throw those things away. Throw them away. The same thing that I did. Throw them away.
Okay.
All right.
Thank you.
But in some way, somehow, it will be relevant small. Some of the things that you learned are the same. So, but you don't worry, you get there.
Okay. Thank you.
All right. So we are talking about consolidated financial statement. We are saying that preparing a financial statement of one or more entity as if they are a single entity. When do we prepare consolidated financial statement? It is when there is a parent-subsidiary relationship. When do we say there is a parent-subsidiary relationship? When the investor, who we call the parent, has more than 50% ownership in the investee, who we call the subsidiary. But if the investor does not have more than 50% shareholding, the investor cannot be called parent and the investee cannot be called subsidiary. But the investor will call the investee an associate when the shareholding is between 20 and 49. But if it is below 20, then the investor will account for its investment in the investee as financial assets. So you only prepare consolidated financial statement when there is a control. When do we say there is a control? There is a control when the parent has power over the subsidiary. When does the parent have power? When the parent has more than 50% shareholding in the investee. So when you have a control, we assume that the control is more than 50%. We assume that the yes.
And please, what you're saying is understandable, but I think you are running very fast, and some of us here are jotting down notes. So
okay.
Because I didn't associate part. It said between 20 to 49%.
You account for that as an associate. The investee will be seen as an associate.
So you mentioned something called, you said something regards to financial assets. When does that come? That also come
below 20%.
Okay, thank you very much.
All right. So can we move on now? Silo, can we move on now?
Sir, yes, sir. Please, we can move on.
Okay, you don't worry, you'll be fine. All
Okay.
right. Okay. So that is basically consolidated financial statement. We are saying that one entity buy more than 50% shares in another company. You see, we have so many ways of business. If a business wants to expand, they have so many ways of doing it. We have the organic and inorganic. We have the internal and merger or acquisition. The internal means you are going to do everything yourself. You want to have a different company. You want to have a different company in Togo. So you are going to use your own resources to go and set up that particular company. That's what we call internal development. But if you don't have the resources to do that, you just go to Togo, look at a company that is doing very well in the same industry that you operate. Then you buy off that particular company. That is what we call acquisition. So that is what we are looking at right now. That is what we are going to look at right now. It is the acquisition. You want to expand to Togo, you don't have the resources to go and do it. You go there and go and buy off the company that is in the same industry that you are operating. That is one way of you getting access to customers in Togo. That is one way of you getting access to customers in Togo. So when do we prepare consolidated financial statement? When the investor has 50%, more than 50% or 50% and above shareholdings in the investee. If you go to the company and acquire only 30%, that particular company will be seen as an associate. If you acquire less than 20%, you have to account for the investment in that particular company as in accordance with financial instruments. But if you have more than 50% shareholding in that particular company, then that particular company will be seen as a subsidiary. After the acquisition, what will happen? Assuming you are going to buy the 70% shareholding in MTN, and the value of the MTN company as at the day that you are buying is 80 million Ghana cedis. And you are paying 90 million Ghana cedis. What is happening? The value of MTN as at that date, the value of your 70% in MTN is 80 million, but you are paying 90 million for that particular 70%. What is happening? Yeah, Philip, what is happening there?
Hello, sir.
Yes.
Please, sorry, the question again, please.
Okay, I'm saying that you are buying 70% shareholding in MTN, and the value of the 70% in MTN was 80 million Ghana cedis, and you are paying 90 million Ghana cedis. What is happening?
You are making a prepayment here.
Hey, who told you that?
They say you are paying more than you should pay.
You are paying more than you should pay.
Yes.
Okay, not that MTN is owing you the 10 million Ghana cedis, which is the SSO, but that is the total. That is the total amount that you have to pay. So it means that you are paying for something that you can't see.
Yeah.
Okay.
Yes.
And what do we call that? How do we call that? If you are paying for something that you can't see, how do we call it?
That is unless you help maybe
For the
give
fact that
some.
I'm saying that what you learn is bogus doesn't mean that all the things that you learned is bogus.
Yeah, I know.
When the consideration is more than the cost of investment, how did you call it at Kotep? How did you call it?
Yes, I have forgotten.
You have forgotten. Okay.
Yeah.
That's nice. Silo, how do we call it? You are paying for something that is not there.
How do you say?
Yes, you are paying for something that is not there. I hope Eva is on this call. Okay. How do we call it? The value of the 70% is 80 and you are paying 90, and that is final. MTN is not owing you. That is the final amount that you are paying for the 70%.
Means that there's a hidden consideration somewhere, which means that if they're not going to pay you back, it doesn't look like it's a deferred consideration anyway.
Okay.
Hello, sir.
Yes. Eva.
Please, sorry for my voice. I lost my voice. But
Yeah.
I'm thinking it's goodwill.
Yeah, it's goodwill. It's goodwill.
Okay.
It's goodwill. Technically, it's goodwill. Why do we say goodwill? It means that there's an invisible item that you are paying for, which doesn't exist. But in actual sense, it exists. It can be the skills of the employees of the MTN, their relationship that they have with their customers, a lot of things that is invisible. But technically, we just call it goodwill. So if you are preparing consolidated financial statements, or when there is an acquisition which is more than 80, which is more than 50%, the first thing that we have to do is that we have to reconcile the consideration with the value of the subsidiary. How much are we paying and how much should we have paid? If we are paying more, then it means that there is something that we are not seeing, which is what we call the goodwill. But if you are paying less, it means that what? If the value should have been 90%, but we are paying 80%, what are we doing? We are paying less, isn't it? We are paying less, isn't it? Eva, are we paying less or we are paying more? The value is 90, but we are paying 80.
The values, we are paying less.
Okay. And what will happen? Is that a gain or an expense?
It will be a gain to us.
It will be a gain to us, isn't it? How do you call that gain?
You
have forgotten it.
Yes.
Okay. Silo, you two have forgotten.
It's bargaining something.
It's a gain on bargain purchase. It is called gain on bargain
Yes.
purchase. It is called gain on bargain purchase. But don't just go and say, oh, okay, you are making a gain, so you just go and realize the gain. No, the standard says that you have to recalculate your net assets. So you have to go and recalculate the value of the MTN. If you are still getting the 90 and you are paying 80, then you can go ahead and recognize this gain on bargain purchase. What do you think will be some of the causes of company having gain on bargain purchase? In under normal circumstances, it should not be a gain. Are you getting it? But there are some things that can cause that. So that particular thing is always called negative goodwill. The gain is, some people call it negative goodwill. So my question is, what are some of some of the causes of negative goodwill? What are some of the things that will bring negative goodwill? Yes, what are some of them? Don't worry, we haven't started yet too. We are doing, most of the people, they have done consolidation before. So let's just go. Then we come back. We come back and start the console. All right. Silo, what are some of the causes of negative goodwill? You have forgotten?
Yeah, I can't remember.
Okay. Eva, what are some of the causes of negative goodwill?
Uh, uh,
You have forgotten. You should just be
no,
free
I've
to
not forgotten, but I don't know how to say it.
say it
When
anyhow.
they are forcefully trying to sell it.
Okay. Okay.
Yes, when
Oh.
they want to sell it because there's an emergency or something.
Okay. That is very nice. That is very nice. When
And
when
when they do not know the full value of the assets they are selling.
Okay. So the first one is when they want to sell Baomis at all costs, they want to sell. So
Yes.
despite the amount that you are offering, the shareholders of the subsidiary, they are willing to sell. So they are desperate to sell. That is one of the reasons. The second one is at the time that they are selling, they don't even have the value, they don't even have the knowledge about the fair value of the assets. They don't have the market value of the asset. They don't know. So since they don't know, they will sell it at any price they are, or they are going to sell it at the carrying value of the assets. But the last one is when the parent is good at the bargaining, is good in the bargaining process. The parent is actually good in negotiation. So you can buy less when you are good in negotiation. So the company has the negotiation skills and they're able to convince them to buy at a lesser price. So basically, these are the three causes of negative goodwill. You can go to the exam, they can ask you, because for this particular group accounts, it is 25 marks. Calculation is taking 20 marks. Theory is taking what? 5 marks. That is why we are going to take our time to look at the theory. Before we move on, I want to say something. Buying of preference shares doesn't give ownership. Why? Okay, let me put it like this. Do you agree that buying of preference shares doesn't give ownership? Do you agree?
Yes.
Why, Philip?
The preference share, like you are just buying a portion.
No, if you buy, no, let me put it like this. If you buy more than 50% of preference shares, doesn't give ownership. True or false?
So I am thinking that yeah, it's true. It's true.
Okay, why? Why is it true?
Because me, to my knowledge, I know for preference shares, no matter the amount you invest, you went in as to be a part owner, unlike the ordinary shareholders. So maybe that would be based on the returns you will be given, the amount you invest to.
So this is how you are going to answer the question in the exam hall. They say, they say the question would be like, despite the fact that preference shares are shares, but acquisition of more than 50% of preference shares doesn't give ownership. Explain your stand. Or if you agree, explain. If you don't agree, explain. So this is what you are going to say if you agree that is true. Hey, Azemeni. Dennis, let's move on. Do you agree? Is it true or false? Dennis.
It's true. It's true that. Good morning.
Yes, how are you?
I'm fine.
All right.
I think preference shares well, no matter the amount or percentage that you acquire, it is a liability,
Okay.
and you have to pay back to the investee first for your how do you call it? Your profit after tax.
Okay. So that is the reason why it doesn't give ownership, isn't it?
The-
All right. Yeah. Also, Habakkuk, do you want to say something? Or you just
I
there?
just came.
You
Yes,
just came. Okay. Eva in Silo.
Preference shareholders.
Mhm.
I'm thinking they are seen as outsiders because they are the first and last to they are the first to be paid in case of anything that happens to the organization.
So since
So
they are
they
the
are
first
seen
to
as
pay,
yeah, they
since
are
they are the
seen
first
as
to pay, they if you
they
buy
are
more
seen
than
as
50,
they helped us and we are giving them their money
okay,
before anything. Yeah.
okay, okay, nice, 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 nice. Silo, are you there? Silo, are you there? AJ, are you there? Akb, are you there? Lodia Mankra, Eric, are you there? SS. Who is that? All right. So do you agree that if even despite the fact that you are going to buy 50% of preference share, it doesn't give you ownership? It doesn't give you ownership. Do you agree? Senior Ado, do you have something for us? Is that statement true or false? Senior Ado, are you there? Philip, do you want to come again?
No, sir. No, sir.
Okay, okay. Oh, Habakkuk, are you there? Habakkuk, are you there?
there.
Okay, the question was we are talking about consolidated financial statements, and we are saying that when you have more than 50% of the shareholdings of a particular company, you are seen as a parent, then you have a control over that particular company. But we are saying that even if you buy more than 50% shares, 50% of the preference shares of a particular company, you will not be seen, or you will not have a control. Okay, if you have more than 50%, or if you buy more than 50% of the preference shares of a particular company, that is not ownership. You don't own that particular company. And I'm saying that is that statement true or false? If it is true, explain. If it is false,
It's
explain.
true.
Okay, Lodia. Why?
Yes, it's true that the preference shareholder is not an owner of the organization because the person just invested into the business, and that at a short while the person will get his returns. But if the person could have been an ordinary shareholder, then you say that maybe that one is a long-term investment and the person may have share in the business.
Okay, that is very nice. That is very nice. Okay, how about Cook? Do you get a question now? Okay, AJ, you want to talk? AJ, do you want to talk? AJ, your network is bad. We can't hear you. How about Cook?
Yes, sir.
Yes. Have you gotten the question?
Yes, please.
Okay.
I think it's a no.
It's false. AJ.
Yes.
Okay.
Yes, please.
Okay. AJ. Okay. AJ too is saying no. Hey. Okay. Oh. Okay. Oh. Yeah, Siniado. AJ is saying no. Hababu is also saying no. Hey. Hey. Okay. Oh. So should we vote according to the yes or no, or we should just say the right thing? All right. It's true. Why? Because preference shareholders are not the owners of the company. So if you are buying preference shares, you are not buying part of the ownership. Preference shareholders are seen to be creditors of a company. So if you are buying preference shares, you are not buying part of the ownership. Ordinary shareholders are the only people that are seen as owners of the company. So if you buy ordinary shares, then you are buying part of the ownership. You are buying part of the ownership. But if you are buying preference shares, we assume that you are buying part of the liability of the company, not the capital. Are we there? That is simply the question. So what then happens when the parent decides to buy part of the preference shares of the company? What then happens? We are going to look at that later. What happens? We are going to look at intra-group intra-group transactions, where there will be a transaction happening between the parent and the subsidiary. How do we go about those ones? We are going to look at that later. But we are saying that we can only prepare group accounts when there is a parent-subsidiary relationship. When do we say there is a parent-subsidiary relationship? When the investor has more than 50% shareholdings in the ordinary share, has 50% of the ordinary shares of the investee. We say that that is a parent-subsidiary relationship. That is a parent-subsidiary relationship. What do we do? Okay, someone is saying that because they don't have a voting right. That is very nice. So we are saying that after you have bought the 50% of the ordinary shareholding of the investee, what do? You are going to pay for it. You are going to pay for it. So we are going to look at ways of paying for that particular 50% or more than that particular 50%, which we call the money that you are paying, we call it purchase consideration. The amount that you are paying, we call it purchase consideration. So we are going to look at the forms of purchase consideration that we have. If you are going to buy something, what are some of the ways that you can pay for it? What are some of the means that you can pay for it? What are some of the means that you can pay for it? Yes, Philip, if you are going to buy something, what are some of the means of paying for that particular thing, Philip? Yes, if you are going to buy something, what are some of the means of you paying for that particular thing?
Say it can be through bank. It can be through the
You can pay through
bank account.
Okay, so the bank accounts that you are talking about, we just assume that you can pay with cash, any of them. So both of them will be seen as cash. All right.
Yes.
Okay, pay by cash. So one of the form is what you call cash consideration. Cash consideration. Cash consideration has to do with outright payment. You buy and you pay with cash. It can be even if you use check, we still call all of them cash consideration. So you pay cash, you pay at once. You pay at once. You pay at once. What are some of the means that you can pay? What are some of the other means that you can pay? So I'm sharing my screen with you. Now we are going to look at it one by one. I've even spoken about the introduction already. So we just look at some of the theory parts, then we start. Yeah. Okay. Someone is saying that by cash, by deferred consideration, by share exchange. Who is that person? SS. Okay, we understood the cash. What do you mean by deferred consideration? And what do you mean by share exchange? Can you explain that to us? Can you explain that to us? Habakkuk, can you explain? Can you help? I don't know whether it's he or she. Can you help us explain the deferred consideration? Deferred consideration. Yes, she sent. Or you say we don't have these slides. It is in the group. I posted group account on Thursday, maybe Thursday, so you can check again. But I'll re-forward it into the group. It is in the group. I posted ratio analysis and group accounts, so they are all there. All right, AJ, they are all there, so you can check the group again. Okay, Eva, deferred consideration. Are we all okay with the cash consideration? Are we okay with the cash consideration?
Yes, sir.
Yes, sir.
Okay, so in the exam, if they ask you explain the following, you can explain them. We are going to name them. There are about 4, so we name them one by one. Okay, Eva, your hand is up. Eva, your hand is up.
I'm trying to say something about the deferred consideration.
Okay.
And with the deferred consideration, it means the cost of investment will be paid at a later date.
Okay. Okay.
So it can be in 1 year, in 2 years, yes, at a later date.
Okay.
And
So,
they will, okay. Please,
okay.
sorry.
They what?
You will be given a percentage
Okay.
at which you will pay that money at that
Okay.
later date.
Okay. Okay. That is very nice. That is very nice. So it is more like you are buying on credit, isn't it? Eva, it is more like you are buying on credit.
Yes, please. Yes.
All right. We get there. We get there. How we go about that buying on credit. Yes. Who wants to talk again? Dennis, do you have something to say about the deferred consideration?
I think she has said all. And then
Okay.
I think that portion that is discounted, maybe you use the count factor to discount
Okay.
it.
Okay.
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 Just as you said, like buying on credit.
Okay.
It's like the investee, or I don't know, will consider that assuming time, just is consideration of time value of money.
Exactly.
Since you are holding my money, I have to charge some interest on it, and
Okay.
that will be discounted.
Okay. The idea is that if you should give me that money today and I should go and invest it somewhere, I'll get some money on it, isn't it? But since you are holding it, I will assume that I've lent the money to you. So you have to pay the interest. All right. So the fair consideration is that the parent don't have the money today. They don't have the means today. But they will say that, okay, we are going to pay you in 2 years' time. So we are going to acquire you today, but we are going to pay the money in 2 years' time. So if you are paying the money in 2 years' time, what do we have to do? We want to know whether we are making a gain or we are getting a goodwill from the acquisition. So what we do is that if we should pay that money today, what should have been the value that we pay? So we find the present value of the amount that we are paying in the future. We are paying the money in 2 years' time. So what should have been the value today if we should have cash and pay? So we normally present value the deferred consideration. It means that the subsidiary has factored interest element over the 2 years. So what we do is that we discount the amount that we are paying in 2 years' time with the cost of capital of the parents. Then we know the present value. That is the present value that will now become the consideration. That is the amount that we are paying today. But the difference over there will be an interest element, which will be a cost to the parent. So we will account for that one over the 2 years. We spread the interest over 2 years, maybe on monthly basis. It depends. It depends. Hey, AJ is saying that the document that I shared on so is not part, but you can see group account over there. AJ, you can see group account there. I will forward it again. AJ, I name it group account, not consolidated financial statement. It is group account. So check again. Maybe you have it, but you don't know. All right. So that is a deferred consideration. You buying now but paying later. But the implication is that what should have been the amount today? What should have been the amount today? What should have been the amount today if you should have cash? Though we discount it to the present value, and it is the present value that we are going to use as the consideration. All right. AJ, all right, thank you. That is it. That is a deferred consideration. And someone also see, somebody said, let me see. Somebody say share exchange. Okay, share exchange. What do you mean by share exchange? So we are looking at types of consideration. Types of consideration. The first one that we look at is cash consideration. We look at deferred consideration, and we're now coming to look at share exchange. Share exchange. What do you mean by share exchange? Habakkuk. Habakkuk, we have all done group accounts at the degree level.
Yes, sir.
Yeah, so if you are here, you don't want to talk. It's something, but
So it's a type of share transaction
okay.
where share of one class is exchanged for share of another class.
Okay. Okay. That is very nice. All right. Eva and Silu.
Share exchange. Okay, so share exchange means they are trying to buy a part of the company, okay, but they are not paying in cash. Instead, they are issuing shares to pay for the investment.
Okay.
So they will issue like 5 shares for 3 of the company they are trying to invest in.
Okay.
So instead of paying cash or using anything to in exchange for that, they will use shares instead.
Okay. Okay. That is very nice. Silo.
Okay, so it's exactly what she said. So it's like being a part owner by issuing of shares. You don't use cash like the other method, but you use shares in the acquisition method.
Okay. Okay. So, all right. Okay. So let's get a difference. You see, if you are paying cash, it means that you are paying, maybe let's assume MTN and Voda. So MTN want to acquire Voda and they are paying cash. It means that they are paying off the shareholders, the ordinary shareholders of MTN. They will no longer be owners of what? MTN. That is the cash or the deferred consideration. They will give them money and that is the end. They don't have any ownership there. But if you are giving them shares in return, it means that we are saying that, okay, we don't want people to go. Hey, please, can you hear me?
We can hear
Yes,
you.
we can hear you.
So Eric, it's your network. If you can't hear me, it's your network. So we are saying that, okay, we don't want to pay people off. Maybe if you are good, you have the skills, you have what it takes to manage a company, you have the necessary skills. So what will happen is that come and be part owners of our company, come and be part of the owners of our company. So we are going to give you shares that come and be part owners of our company. So instead of them paying cash, they will give them shares in it. They will give them shares. They will issue additional shares and they welcome them as the ordinary shareholders of the parent company. That's what they normally do. And these shares will be issued in some manner. Maybe the parent might be doing well than the subsidiary. So they can say, okay, bring 5 shares in your old company and come and take 3 shares in our company. So it can be 3 for every 5 shares in the subsidiary. So they will give you a ratio. They will give you a certain ratio. How do we go about it? We are going to look at that later. How do you go about it? So it can be that 2 for every 5 shares, 2 for every 5 shares. So they are telling the shareholders of the subsidiary to bring 5 of their shares and count for 2. 5 of their shares and count for 2. So if they are having, if the parent is buying 15,000 shares, what will be the value of that 15,000 shares in the parent company now? If the parent is saying that 2 for 5, bring 5 old shares, 5 of your shares and come for 2. What will be the value now? If they are buying 15,000 shares and they are saying that bring 5 for 2, bring 5 for 2. What will be the value of the shares in the parent? What will be the value of the shares in the parent?
Bring 5 for 2.
Yes. And they are buying 15,000.
So it will be 2 over 5 times the 15,000.
It will be 2 over 5 times what?
The 15,000.
Times 15,000. Okay. How do you come with that particular fraction?
Okay, so depending on which figure comes first, if the two, okay, I use this analysis. If the two comes first, maybe in the statement they will say 2 for every 5 shares. So that
Okay.
means that because they said the 2 for every 5 shares, it will be the 2/5.
Okay.
That's how you come with the fraction.
Okay.
Times the figure, the
Okay.
15,000.
Okay. That is very nice. But we have all learned ratio and proportion, isn't it? We have all learned ratio and proportion, isn't it? Oh, SHS. We have all learned ratio and proportion. Habakkuk.
Yes, sir.
All right. So the ratio is 2:5, 2 for 5, isn't it? So if 2:5, then what will be to 15,000? Then you come with the ratio. Or another way of doing it is that we are having 15,000 shares, and they are saying that we should bring every 5 of these shares for 2 in the new company. So how many 5s can we see in 15,000? How many 5s can we see in 15,000? How many 5s are there in 15,000? How do we do it? We do 15,000 divided by 5, isn't it? How many 5s are there in 15,000? It's 3,000, isn't it?
Yes, sir.
So this 3,000 will go for 2 shares in the new company. So you just multiply the 3,000 by 2. So you bring 5 for every 2. So how many 5s can we have in the shares that we have? Okay, we are going to have 30. Then the 30 will now multiply the 2. So we have 6,000. And this 6,000 is the shares, is the number of shares. But we are looking for the value. So we use the parent share price to multiply this 6,000. But don't worry, we pick a question and we look at it while we explain it again. All right, we explain it again. Let's move on. Someone said another one is contingent consideration. Okay, contingent consideration. So the third one was share exchange. The next one is contingent what? Consideration. What do we mean by contingent consideration? Contingent consideration. Philip, are you there? Philip, are you there?
Yes, sir.
I hope you are now understanding the fact that what you learn is bogus. Okay, let's move on. All right, contingent what? Consideration. Contingent consideration. Habakkuk, do you have something?
No, sir.
Okay. Okay, you two, what you learn is bogus, isn't it? No, some of the schools, what they learn is no bogus, like schools like UPSC, unless the student itself is bogus. Okay. Lodia. Contingent consideration. Do you have something for us? Or some of us, the time that we completed school is too, like, it's long, so we have forgotten the things. Maybe I better find. Silo, contingent consideration. I'm even waiting for the person who said the contingent consideration to send me the answer. Silo, do you have something there? Contingent consideration. Do you have something for us?
I'm trying to. I think it's dependent on whether it will occur. Like there's a future occurrence or non-occurrence. I'm trying to put my mind to it, but so it's looking at whether like something it would occur in the future or not. I know.
Okay, well, you know of it, but you don't know. You don't know the meaning.
Yes. I can't really explain. Yes, I know, but I can't really explain it.
Okay, so that means you'll be, if they give you the 4, you'll be able to explain 3 and explain the remaining 1/2. Okay, That is not bad. 3 out of 4 is a nice thing. Eva, I know you don't want to talk because you two, you don't know how you are going to put it, but I'll mention your name. Eva.
Please, is it the one that you buy with loan? There's this loan something or something.
No.
Oh, okay.
Okay, so I'm thinking with contingent consideration, it happens when a certain target, for instance, a certain target is achieved.
Okay.
Yeah, a certain target is achieved. So if it happens, then we'll pay this. So
Okay.
it will be given like in a statement, it will be given like if the company achieves this target, 80,000 will be paid.
Okay.
And if it doesn't, no money will be paid or something. So it's dependent on you achieving the set target or something.
Okay. That is very nice. All right. With a contingent consideration, what normally happens is that, okay, we are going to pay 100,000 Ghana cedis for you. But this 100,000 Ghana cedis will be paid when you are able to achieve a profit of 10,000 Ghana cedis. So for this particular consideration, it is dependent on a condition. There's a condition attached to it. So we will pay you 100,000 Ghana cedis if you're able to reduce your labor cost to this amount. If you're able to reduce your production cost to this amount, if you're able to make a profit by this percentage, if you're able to reduce your cost of sales or cost of production by this percentage, that is only when we can pay this amount to you. So the contingent consideration is basically amount given. We agree on the amount, but we are going to add condition to it. So if MTN, the shareholders of MTN, we are going to pay you 10,000 Ghana cedis in 2 years' time. But with the contingent consideration, there is nothing like present value and no, it is the same amount that we are paying. The amount that we're supposed to pay, it is the same amount that we are going to pay on a later date. But just that we are saying that we are only going to pay this if you're able to achieve this percentage. So, okay, we are going to pay you $100,000 or $100,000 if you are able to achieve a profit of, or if you're able to increase your net profit margin by 20%. So we are going to pay. So it means that if you are not able to achieve your net profit margin or the target given to you, then we pay a lesser amount. So what normally happens to a contingent liability is that, as a liability consideration, is that, okay, the shareholders of the parent are saying that we are going to pay this amount, but we are only going to pay this when you are able to achieve this. So initially, we recognize that as a liability, but because we are here to pay it. But what normally happens at the end of each reporting period, we revalue the liability because it's a debt. You have to know the value that you're going to pay at the end of every month. So we revalue it. If there is increase, then that will be an expense to us. We send it to profit or loss. If there is a decrease, that is a gain to us. We send it to profit or loss or return earnings. So that is basically about a contingent consideration. The amount is agreed on, but condition is attached to it. So if you see it, how do you treat it? You are here to pay. It's a liability. Then at the end of each reporting period, go and revalue your liability to a fair value. So if there is increase, assuming the beginning is 100,000, at the end of the year is 120, that means you are going to pay more. So the 20 over there should be recognized as an expense. But if it is 120 at the beginning, at the end is 100, then it means that it has reduced. So the reduction, which is 20, is a gain. You still send it to profit or loss as a gain, or you send it to return earnings. All right. That is basically about the contingent consideration. Consideration can also be settled by issuing, okay, Eva.
So please, can you, with the treatment of the contingent liability,
okay,
consideration,
okay,
it's kind of some way, so please, can you go over again?
Okay, I'm saying that at the initial state, if you determine the value of the contingent consideration, that is what you are going to use as a consideration in calculation of your goodwill. So at the initial stage, which is the beginning of the year, it should be recognized as a liability because that is the amount that you are going to pay to someone. But at the end of every reporting period, you have to revalue it to the fair value. You have to know the amount that you are going to pay at the end of every reporting period. So if the initial amount was 100 Ghana cedis, and at the end of the year is now 120, it has increased by 20. So that 20, which is an increase, is a loss. So you send it to profit or loss accounts if you are preparing consolidated statement of profit or loss. But if you're not doing that, you're preparing only financial position, then you send that to retained earnings as an expense. You go and subtract it from the retained earnings. But if from the beginning it was
Hello,
120, yes.
So when you take it to the profit or loss, how will you name it? Loss or profit on contingent consideration?
Anyhow you name it. You just have to make sure that contingent is there.
Is there?
Loss on revalue, fair value loss of contingent liability, or remeasure loss on contingent liability or contingent. Anyhow you measure you. The only thing is that they are not going to mark the description. It's only the figures. So the figure has to be correct. All right. Are you okay there?
Yes, sir.
So if at the beginning is 100 Ghana cedis, and you are at the end of the year, if the beginning is 120 and at the end of the year is now 100 cedis, you can see that it has now reduced to 100. It has now reduced by 20. So that one will be seen as a gain. So that gain, you either send it to profit or loss, or you send it to retained earnings. Are you okay?
Okay.
All right.
So once you send it to profit or loss, you don't send it to retained earnings.
If you are preparing statement of financial position again, you don't have to send it there because you send the profits. The profit that you are going to share will go to retained earnings. But if you want to use the share of profit from the net asset table, then you have to come and send the gain also to retained earnings because the gain will not be part of the profit that you are going to share in the net asset table.
Okay.
All right. But don't worry. I will just try to see if I can get a question on it, then we solve it. All right.
Okay. Yes, sir.
Can we move on now? Can we move on now? Eva, can we move on?
Yes, please.
Are you clear?
I'm clear. So we solve questions. That particular one is a problem. So
that is not even a problem. There are problems that there are a lot of problems that we come across. Don't worry. The problem is the intra-group transactions. When you buy loan notes, when you buy preference shares, what will happen? When you buy boosts, what will happen? Some of you know how you do it, but you don't even know what you are doing. All right, let's move on. Hey, Eric, we should start what? The class is in session, or you cannot still hear me. Eric, what are you talking about? All right. So basically that is the fault that we have, but there are so many ways of settling your investments, your cost of investments. Another way is you can also issue loan notes to them. You can also issue loan note to them. Eric, can you hear me? All right. Another one is, okay, you have liabilities, or you can also issue debentures to them. You can also issue loan note to them that, okay, come and be part of the creditors that we have, come and be part of the debenture holders that we have. But you can see that is not factored in the types of consideration. You can also issue loan note to them. So if you're issuing loan note to them, initially what will happen? You are going to use the fair value of the loan note that you issue as a consideration. That is the amount that you have paid. But what will happen to the loan notes? Those people, they will be creditors. We are owing them. So that will be a liability. And at the end of every year, we are going to be paying them interest on the loan notes. So you have to take that into consideration. The loan notes will be seen as a liability and you'll be paying interest on it every day. Another way of settling the consideration is issuing to them or giving them non-current assets for the shares. You give them assets because we have more assets. We want to sell some of them off. Okay, let's just give you people the asset that we have. We are using assets to settle them. And in March, that was the part of consideration that came. They give them assets instead of cash, instead of deferred consideration, instead of contingent, instead of loan note. They give them assets. And my students, some of the students, they haven't seen this type of transaction before. They don't know that they can give them assets, and they were there. They don't know what to do. But that in itself doesn't mean that you should not go and do the thing. You see, that one price, it will take like maybe 2 ticks. Go and do the things that you know. You see, for the fact that I don't know how to treat one foot, no, doesn't mean that you can't do that. Leave that one and go and do the other thing. You see, leave that one and go and do the other thing. Leave that one and go and do the other thing. Don't say you can't do that. That is a no. So that is some of the other means of settling it. That is some of the other means of settling it. So we are done with the types of consideration. But before we go to some parts of the theory, I want to say this. You see, if you are saying consolidated financial statement, it means that we are putting the financial statement of two entities together. If the acquisition is a whole year, it means that the financial statement for the whole year will be put together. So what you are going to do is that before you even start the workings, you see, my brother, if it is statement of financial position, even it is a 6 months, if you buy the company, maybe 6 months to the financial year, if it is a financial statement or statement of financial position, you will still add the two figures. My brother, don't go and waste your time on the workings. You see, just go and prepare your this thing down, put the financial statement down. If you have PP, property, plant, and equipment, take the parent own, add the subsidiary own to it, put it in bracket, leave a space. If you are going to do any workings that will increase or reduce, you come and add or you come and subtract. You do it for all the items there. You add them in a bracket before you come to the workings. If it is statement of profit or loss, if it is a full year, come and add the revenue for a parent, add a subsidiary to it. Then you do it for all the items there before you come and subtract any workings that you are going to do. If it is a 6 months, that means that you are only going to add a 6-month portion of the statement of profit or loss for the subsidiary. So if you have the subsidiary figure, which is 12,000, that is 12,000 for 12 months. You just prorate it, maybe 6/12. If it's 6 months, 6/12 times that 12,000. Then you do it in the bracket and add it to the parent's amount. Don't go and say you are going to do workings before you come and do that. Don't worry. We are going to show that in a practical example. So that is one of the secrets about the console. Don't say you are going to do workings. Some of the workings, even if we give you the full day, you can't do it. So just go and add a figure. It is a figure they are going to map. Add it. If it is 9 months, just make sure that you multiply the subsidiary's revenue or cost of sales by 9/12. Then you come and do any workings that you do. That is it. All right. So let's look at some of the theory questions that will come. We have looked at one already, which is the types of consideration. Let's look at what we call control. Control in this case will basically be defined as the parent or the investor having more than 50% of the ordinary shares in the investee. That is control. So in this case, we are going to say that control is where the investor is having more than 50% of the ordinary shareholdings of the investee. That is control. But in any case, control can be exercised in the following ways. Let's look at it. Although you can be having 20%, you can be having 20% shareholding. You can be having 20% shareholding in MTN. But the remaining 80% shareholding is being spread among individuals, 80 people. So one person is having 1%, one person is having 1%. In times of voting, in times of you deciding on matters in a general meeting or something, you are going to have a major say because you alone is having 20%. and the remaining 80% is being shared across 80 people. It means that one person will be having what? 1%, one voting right, but you are having 20 voting rights. So in terms of on individual basis, you are going to have control in meeting. You are going to have control over matters in meeting, but you can only lose or lose this control when those 80 people comes together. When those people comes together as a group and they say they want to defend against what you are saying. But if you are taking this on individual basis, you as the person having 20% will have control. If you are talking about individual, if you're in a meeting, we say we should all vote. It means that if I say something, because I'm having 20, if I say something, yes, that particular team will have more power than you people, because you could, if they are taking only you, you have only 1%. So what are you saying? The 20% can not exercise control when those 80 people have come together. So if they are come together on the matter, it means that it will be 80 against what? 20. So in that case, you don't have control. But if this 80% is being spread among people, you have control. You have control. But what we are going to do for control, we are going to assume that control is only exercised when there is more than 50% ownership of the ordinary shares. But what I'm saying right now, we are not going to use that. But I'm saying that there can also be a control when this situation exists. Okay, assuming you have 20%, someone also have 15%, and in meeting, this person wants to take his stand with you. You want to take his stand with you. So in all, the two of you are having 35%, and the remaining 65% is being shared among people. In this case, you can say that to get you together with that person, you have a control. But we are not going to apply these principles. We are not going to apply this principle. But if in the exam they ask you, maybe how can control be exercised? You can say control is exercised when the parent is having more than 50%. You can also say the other one, when the parent is having 20, but the remaining 80% being spread among individuals. It means that the parent is going to have more voting rights, more say in the meeting than the other people on individual basis. All right. When do we say there is a control? The first one is when the parents have control or have power over the investee. Have power over the investee. You can only have power when you have more than 50%. Power means you can say this, you can say that, they will go according to it. All right. B is exposure to or right to variable returns from involvement with the investee. So the returns we are talking about is the money. So you have a right to the returns. Well, what the parent is, what the subsidiary is going to get, the profit, you have a return. And you can also decide on who should appoint on the board and who should not be part of the board. You can decide on who they should employ and who they should not employ. We say you have a control. The ability to use its power over the investee to affect the amount of the investor's return. So if you are saying the ability to use the power to decide on how much they should pay to investor, it means that in terms of dividend, you say that, okay, return this profit and pay this amount as dividend to the people, because you are the owner. Technically, you are the owner of the investee. So we say that these are the three ways of having control. So if in the exam they ask you what is control, you can even state this. You can say control over investee exists in the following ways: power over the investee, exposure to the right. You can say this. You define control. That's all. We move on. Are you there? Are you there? The standard is saying that if there are changes to one or more of these three elements of control, then an investor should reassess whether it controls an investee. So when there is no power, means that when you now have less than 50%, you have to reassess whether there is an element of control. If there's no element of control, then the parent-subsidiary relationship is no more there. It will now be parent-associate or a financial asset. All right, let's move on. Do you have any question? Do you have any question? Okay, when do we say there is a power? existing right that give the current ability to direct the relevant activities of the investee. Power can be obtained directly from ownership of the majority of the voting rights, can be derived from other rights such as. So power is basically when you have more than 50% of the shareholding of the investee, which we call the subsidiary. But in other words, power can also be exist in these 4 ways. The first one is right to appoint, reassign, or remove key management personnel who can direct the relevant activities. So I've said that already. We are telling the subsidiary who they should employ, who they should not employ, or if the management are not doing well, the parent can sack them. You see, you have a power over that. Right to appoint or remove another entity that direct the relevant activities. So if there is an entity who also owns maybe part of the shareholdings of the associate, and you can say, okay, we don't want you again, so you have to pay off your investment to you. You have to pay off your investment to you. It can be like preference shareholders. Preference shareholders can also dictate what the company can do because they are also more concerned about the investment. But we are saying that, okay, we are tired of people saying you're rubbish. What we are going to do is that we are going to settle off your investment. We are going to buy back the shares. We are going to buy back shares. So if the parent is buying the preference shares in the subsidiary, the assumption is that the parent is buying back its own preference shares. It is paying off the preference shares because the subsidiary is now part of the parent. So the subsidiary is the parent's company. So you can't be buying your own company, but in other words, you are buying back your shares. So you are paying to the preference shareholders. You are paying to the preference shareholders. That is one of the intra-group transactions which we are going to look at later. So right to appoint or remove another entity. So the preference shareholders, you can pay them off. Right to direct the investee to enter into or veto changes to transactions for the benefit of the investor. So the management of the investee want to go and invest in Maersk Gold. The shareholders or the management of investee want to invest in Maersk Gold. And the shareholders or the parent is saying that no, investing in Maersk Gold is too risky. You see, our investment might be lost. So what do? They will say, no, don't go there. Come to this place. They want to invest in Aviator, Betway, Bet Power, Sporty Bets. No, they are saying that this investment is not good. So what do? Don't invest here. Go to this place. That is what we are saying over there. Other rights, such as those specified in management contracts. So there may be other rights which might be specified in a management contract. Those rights can also give power. All right. Let's come to what we call significant influence. If you are talking about significant influence, I've said that already, where the investor is having more than 20 but less than 50 shareholding. So that is 20 to 49. If you're having 20 to 49% of the shareholdings of the investee, we say that you have a significant influence, but not control. You have a significant influence, but not what? Control. Not control. So significant influence can be determined by the shareholding of the voting right, usually attached to shares in the entity. IAS 28, investment in associates, states that if an investor holds 20 or more, but less than 50% of the voting power of the investee, it can be assumed that the investor has significant influence over the investee, unless it can clearly show that this is not the case. So if you talk about significant influence, basically we use what? Percentage holding to determine that. So if the percentage holding is 20 or more, but less than 50, we say that you have a significant what? Influence. You have a significant influence. And how do we account for this? We account for this using what you call equity method. Let's look at some of the factors that will indicates significant influence. This part of the slides is one of the popular side that the institute normally examine for the 5 marks. You can see that all the factors over here, they are 5. So they can just say, they will give you a scenario, then they will ask you this question for 5 marks. It's a popular site. They have examined this for 2 times. That was in May 2021 and April 2022. The last question for 5 marks. So let's look at what are some of the factors that shows significant influence. The first one is the representation on the board of directors of the investee. So it means that the board of directors of the investee, the parent is also going to have, or the parents, the members of the parent or the management of the parent, some of them will be part of the board of directors. They will be part of the board of directors, or some of the shareholders of the parent will be part of the board of directors of the investee. Will be part of the board of directors of the investee. Participation in the policy making process. So when they want to make management policies, employees policies, health policies, the parents will take part. The parents will take part. So the parents will also be part of the policy making process. What policies should we make, and what are things that should go in? They are not going to do this in the absence or without the knowledge of the parent. The parents, some of the management of the parents or the shareholders of the parents will take part in this. If there is something like this, we say that there is a significant influence. The C is material transactions between the investor and investee. We are not saying that you sell goods to someone, maybe 40 cedis, and you are saying that you are having significant influence. No, they are saying material. The transaction should be a material. The amount involved should be huge. So the parents will sell to the subsidiary for 40 billion, like 40 billion, something that is material. No, like 40 cedis, nah, 40 cedis. You can only sell to someone for that particular amount of money when you trust the person, when there's a relationship between the person. You don't know me, there's no relationship between me, and you say that you are selling goods to me for 40 million on credit. It doesn't make sense. Are you getting it? So there should be a material relationship. The amount involved should be very rich. If the amount involved is very rich, we assume that, okay, then there is a kind of relationship between these people. That is why the person trusted this particular party and made that kind of sales to the person. The next one is the interchange of management personnel. Interchange of management personnel means the investor will give, maybe you can transfer some of their employees to the investee, and the investee can also give out some of the employees to the investor. This can only happen when there is a kind of relationship between the people. You don't know MTN, you don't know Voda. You say that you are taking some of your employees to them. No, that cannot be possible unless the employee decides to leave and go and seek for another opportunity there. Ghana cannot say they are exporting the nurses to UK when there's no relationship between Ghana and UK. But that can only happen when there is a significant relationship between them. The E is provision of essential technical information. Provision of essential technical information. Provision of essential technical information. Let's come to the consolidated financial statement itself. Consolidated financial statement itself. Consolidated financial statement itself. What do we say about consolidated financial statement? I have explained that before we start the class. So what I want to say is that look at the conditions that give rise to significant influence. My brother, if you are reading, at least try to memorize the words. The 5. If you can't do it, just look at any acronym that will help you to do it. You can say PPPMI. PPPMI. Oh no, it's not PPP. It's the first one is R. So you can say PPE RMI, or any acronym that you can use that will help you. All right. You can also look at control. When do we say there is a control? When do we say there is a power? these areas have been examined before. They are here to examine the types of consideration. So if you're learning the theory part for 5 marks, make sure you pay attention to the types of consideration too. We have looked at that and we have explained that too as well. So let's look at what we call the consolidated financial statement. But before we go to the consolidated financial statement, I want to say something. We are saying that if the parents owns more than 50% of the ordinary share holding of the other company, we say that the parent is having control and that particular company is now a subsidiary. So if the parent is having 70%, it means that there's a portion that the parent is not controlling. So if the parent is having 70%, what portion is the parent not controlling? What portion of the ordinary shareholding is the parent not controlling? What portion of the ordinary shareholding that the parent is not controlling? What portion? What portion? Habakkuk, what portion?
Sir, hello?
Yes, I can hear you.
Non-controlling interest, or
What portion? What portion? I want figures. What portion? The parent
the
is
question
having,
again.
I said the parent
Uh-huh.
is controlling 70%, and there's a portion that the parent is not controlling. What portion is the parent not
30%.
controlling? 30 what? Percent. And this is called what?
Non-controlling interest.
Okay, why is it non-controlling interest? Okay. Because it's
And
not
because
control. All right. Because let's move on. Because what?
Because it's the parts which the parent is not controlling.
It is a part that the parent is not controlling. Okay, that is very nice. That is very nice. That is very nice. All right. Okay. You see, don't worry. This we are just doing, we are going to take the calculation parts and everything will be fine. There are some principles that you have to understand. You have to understand what you are doing. If you are sending a figure there, you have to understand why you are sending that figure there. I keep on telling people that if you understand consolidated financial statement in and out and in, there is no question in the exam that you can't do it. There is no question in the exam that you can't do it. All right. There is no question in it. Whether you have seen it before, you haven't seen it before. If you understand what should go here and what should not go here, you don't have a problem. All right. So if the parent is having 70, any portion that the parent is having, the remaining portion that the parent is not controlling is what we call the non-controlling interest. Those days we do call it minority interest. Minority interest. But the standard, which is the IFRS 10, has changed it to non-controlling interest. What is consolidated financial statement? What is consolidated financial statement? You can go to the exam, they can ask you what is consolidated financial statement. What is consolidated financial statement? Eva, what is consolidated financial statement? Yes.
Yes, I'm here.
Okay.
Because this is a financial statement which is prepared in which the assets, liabilities, and the equity of both companies are prepared as if it's one company.
Okay.
They are joined together.
Okay.
So all the assets are joined together and prepared as if it was for one company.
Okay, that is very nice. That is very nice. That is very nice. Okay, before we move on, you see, what we are going to do in this particular session, what we are going to do in the consolidated financial statement, we have so many methods of this one, but we are using what we call the acquisition method. We are going to do what we call acquisition method. We are not going to look at maybe the companies are just coming together like merger. No, it's not merger. It's not something that is a takeover. No, it's not a takeover. It's not a merger. We are assuming that it's an acquisition. The parent is actually paying cash for it. That is what we are going to look at under the consolidated financial statement. The group accounts, what we are going to look at is that we are assuming that the parent is actually acquiring the subsidiary. The parent is paying money for it, not that the parent is taking over the subsidiary, not that the parent is doing merging or doing merger with the what? With the subsidiary. It is acquisition. It is acquisition. So you have to also be mindful that there can be a group account where there is a takeover. So they prepare the account as if there is one entity. There can also be a group account when there is an issue of merger. But what we are doing over here is that the parent is actually the parent is the parent is paying for the shares. The parent is acquiring the subsidiary using cash or paying for it. That is what we are going to look at over here. Are you okay? All right. Please let me pick this call in. All right. So let's move on. You see, the standard is saying that in any case, when there is a control, one company must consolidate the other company, meaning that they should prepare their financial statements as if they are a single economic entity. So when you have more than 50% shareholding, ordinarily, you have to prepare what we call consolidated financial statements. But there can be a situation where you will be having more than 50%, but you still not prepare group accounts. You still not prepare group accounts. Let's look at some of the conditions that will give rise to that. You have 50%, but you're not permitted to prepare a group account. These are some of the conditions. So these are some of the exemptions from preparing group accounts. They are here to examine this, so you have to take it seriously. All right. Okay. The first one is what? Habakkuk. The first one is what? Habakkuk. The first one is what? Yes, John. John, you want to talk? The first one is what? John, do you want to talk? Okay, Habakkuk.
Yeah, hello.
The first one is what?
So it's when the parent itself is a partly owned parent organization.
Okay. Okay. What do you mean by that?
It means the company, which is the parent here,
Okay.
is also owned by, or is also controlled by another organization.
Okay. Okay.
Yeah.
Okay. That is very nice. So what we are saying is that if the parent itself is a wholly owned or is a partly owned subsidiary of another entity, what do you mean by this? Habakkuk is the one buying 70% shares in my company, or Habakkuk is the company A and I'm the company B, and he's buying 70% of the ordinary shareholding of my company, which is the company B. Company C, which is Eva is also having 70% of the ordinary shares of Habakkuk. You can see that Habakkuk has control over me and Eva has control over what? Habakkuk. So Habakkuk cannot go and say he's preparing consolidated financial statement because Eva is going to consolidate Habakkuk's account. So what will happen is that Eva is the main parent. So Eva will be allowed to prepare a consolidated financial statement, consolidating the two of us, Habakkuk and myself. So in this case, we call something subsidiary relationship. So Habakkuk is a subsidiary of Eva, and I'm a subsidiary of what? Eva. This is what we call advanced consolidation, where I'm going to teach the corporate reporting students. This is advanced consolidation, where we have something we call complex groups. Complex groups. So in this case, Habakkuk will not be allowed to consolidate my company or me, but Eva will consolidate the two of us. That is the issue over there. Its securities are not publicly traded. Its securities are not publicly traded. When you are a private company, you can decide not to prepare if you are not listed on the stock exchange market, you are not obliged. You are not being forced to prepare financial statement for publication. So you can decide to prepare a group account or not. But in any case, you prepare what individual account for the shareholders. But those companies that are listed on the Ghana Stock Exchange market are those that, whether you like it or not, when there's a subsidiary, parent-subsidiary relationship, you have to prepare the consolidated what? Financial statements. Consolidated financial statements. So if your securities, your shares are not traded on the Ghana Stock Exchange market, you can decide to prepare consolidated financial statement or not. Are we okay then? Are we okay then? Can we move on to the next one? The next one, it is not in the process of issuing securities in public securities market or public security markets. So in this case, you want to, maybe you don't have the intentions to trade on a Ghana Stock Exchange market. You don't have the intentions to be there. So that is, you don't want to be there. Your securities are not to be traded in the public. So there's no reason for you to prepare consolidated financial statement. But if you're in the process of issuing your securities to the public will like to know how you are doing, and they will be interested in every part of your business activity. So you have to prepare the consolidated financial statement. But if you're not in the process of doing that, don't do anything. That is the issue over there. That is the issue over there. What is the next one? The ultimate or the intermediate parent publish a consolidated financial statement that comply with international financial reporting standards. So what we are saying is that looking at the first point, or a subsidiary, another subsidiary, which is the ever prepare and publish consolidated financial statement that comply with the international financial reporting standards. The parent will not be allowed to prepare consolidated financial statement because this has been done by another company already. So the subsidiary can go ahead and prepare consolidated financial statement on behalf of the parent. If this comply with the international financial reporting standards, the parent will not be allowed to prepare consolidated financial statements. So when the parent does not prepare consolidated financial statements, the parent has to prepare a separate financial statement and make the following disclosures. So IAS 27 is separate financial statements. So when there is no consolidated financial statement, the two entities will prepare separate financial statement. Habakkuk will prepare its own financial statement for each shareholders, and I also prepare my financial statement for the shareholders. If this happens, what are some of the disclosures that you have to make? These are the disclosures. You have to give a description about the method used to account for the investment. You have to give a disclosure about your percentage shareholding. Is the shareholding being controlled jointly or how? Okay, you have to give those things. So if you have any time, you can look at those one separate financial statement. Look at the disclosure. Let's look at the content of consolidated accounts. The first thing that you have to do is that you have to tell the people, the public, about the relationship. If I say the relationship, what percentage that you are controlling as a parent and what percentage that you are not controlling, which we call the group structure. So you have to tell the public about the group structure. Which portion are you controlling as a parent and which portion are you not controlling as a parent? So if you're having 70, you say parent is having 70 and the NCI, which is a non-controlling interest, is also having 30. That is a group structure. Basically, that is a group structure. And in the exam, the group structure will take mark. It will take one, it will be one of the things that will take the ticks. The second one is a consideration, the purchase consideration. How much are you paying for it? You have to tell the public that the 70% that I'm holding, this is the amount that I have paid for it. This is the amount that I have paid for it. And if the 70% is 40 Ghana cedis and you are paying 40 Ghana cedis, it means that you are paying for everything. You are paying for, the thing is 40, you are paying for 40. There is no gain, there is no loss. There is no gain, there is no loss. But if you are paying more than what you should have paid, the fair value of the subsidiary at the date that you are acquiring them is 40 and you are paying 50 cedis. It means that you are paying more. You are paying for something that is not there. And that particular something is what we call goodwill. So if you have a question, what you have to ask yourself is that how much is the parent paying and how much should have the parent paid? How much should have the parent paid? So what you do is that you have to look at the net assets of, or the value of the subsidiary. The value we are talking about only in the shareholders fund, because it is the shareholders, it is the ordinary shareholders that will give you control. Those are the owners. So what is the value of the owners fund, which is a shareholders fund? What is the value of their fund? So what portion relates to what I'm buying, which is a 70%. So if you are buying 70% and the value is 100,000 and they are saying that the NCI portion is what? 30. So the 100 is for the 100%, but you are taking only 70. And the portion that you are not controlling is 30. It means that you are buying only 70. The portion that you are buying is 70. It's worth 70 and you are paying 80. What is happening? You are paying more. So the excess, which is 10, will be seen as a goodwill. So in any case, when you are given a consolidated financial statement or when you are given a group account, you have to test whether there is a goodwill or there is a gain or bargain purchase. How do we do this? You look at the amount that you are paying and you look at the value that you are paying for. So how much am I paying? How much should I, all things being equal, how much should I have paid? You subtract it, then you have a goodwill. How do we do this? You look at the value of the shareholders at the date of acquisition, which we call the net assets. The net asset. We look at how we do that. So that is a consideration. The consideration is the amount paid by the parent towards the acquisition of the share capital of the subsidiary. So in the books of the parent, it is represented as assets, which is investment. So when it is paid, debit investment, credit cash. So if you have a consolidated financial statement, what you are going to see is that you see investments, and at the parent, you see investment over there. And the investment, maybe they can say investment in B. They will mention the name of the company. But don't assume that all the investments under the parent are the investments in the what? In the subsidiary. Sometimes the parent can have other investments and the parent will add this one to it. So in any case, you have to reconcile the investment. You have to find the consideration, the amount that the parent is paying, and compare with the investment figure under the parent and see whether it is the same as the amount that the parent is paying. If it is the same, that investment is entirely the investment in the subsidiary. But if it is not the same, then the remaining portion will be seen as other investments. So don't go there and say you are taking the investment as a consideration paid. No. They will give you information on the consideration, calculate the consideration, compare with the investment figure under the parent. Is it the same? If it is the same, it means that the investment over here is entirely for the consideration. But if they are not the same, what is the difference? The difference will be other investment. The parent can have a financial assets. The parent can invest in subsidiary, other subsidiary or other associates. So don't take the investment to be entirely a cash consideration. No, try to reconcile it. Find the amount paid, compare with the investment. If it is not equal, the excess will be other investments. Are we okay there? Are we okay there? Are we okay there? Are we okay? Can we move on? CeeLo, can we move on? All right.
Yes, sir, please.
Okay. Let's move on. All right. So we look at the forms of cash consideration. We have spoken about that already. Cash consideration, deferred consideration, contingent
Yes, I'm
consideration.
okay.
All right. Exchange, share exchange. All right. Let's come to another thing that you will be expected to show in the exam. But in any case, is you can decide not to show it. Media, most of the times I don't show it. Most of the time I don't show it. Because this net asset thing, to me, it's not necessary to me. But I will show you how you can show it and how you cannot show it. So we are saying that at the date of acquisition, we have to know whether the money that the parent is paying, the consideration that the parent is paying, that's supposed to be the amount that the parent will pay. So we look at the net assets of the subsidiary at the date of acquisition. The net asset over here, we're really talking about the one relating to the what? To the ordinary shareholders. So the only thing that we do is that we use the accounting equation, which is asset minus liability is equal to equity. But in this case, the asset that they are going to give to you will be the asset at the end. So we can't actually factor or figure out the asset at the day that you are acquiring the subsidiary. So we ignore the asset minus what? Equity. But so what we do is that we just use the equity method. So we take the ordinary shares, the value of the ordinary shares, then we add the retained earnings at the beginning, the time that we are acquiring it, because they will give you that particular figure in the footnotes. So you take the ordinary shares. We assume that there is no additional issue of shares during the year. So we take the shares at the beginning, is the shares at the end. We take the value of the ordinary shares. You add the retained earnings at the beginning. You add any capital surplus, any other component of equity, anything that is relating to the ordinary shareholders, anything that is relating to the ordinary shareholders. So you know that if you take the equity portion, it's the same as the asset minus liability at the day that you are acquiring it. So we take the ordinary shares, we add the retained earnings at the beginning or at the time that you are acquiring the subsidiary, or at the date of acquisition, you add any capital surplus, any other component of equity at the date of acquisition. Then that will now be your net assets. But fair value measurement says that at the date of acquisition, the assets and liabilities of the subsidiary should be measured at fair value. So I will show something with you right now. Let me share this with you. Let me show you an example right here. All right, can you see my Excel sheet?
Yes, sir.
You can see the plain one, or you can see the one that they are written stock sheet on it.
So I can't see anything.
You can't see anything. Are you sure? Can you see now?
See this is a plain sheet. Yeah.
The plain sheet.
You can see the plain one, isn't it? All right.
Yeah.
So what we are saying is that the accounting equation is assets minus liabilities will be equal to what? Equity. But you can't use this. All right. But you can't use this in examination because the asset figure that will be given to you will be the value at the end. But we want the value at the time that we are buying the subsidiary. The liabilities will be given to you will be the liability at the end. It means that maybe after acquisition, they can acquire additional assets which were not there before we acquired them. So it will be part of the assets. So that will be very difficult for us to determine our net asset using the accounting equation. So what we normally use is that we use the equity method. So we use the equity portion. So the question will give you the retained earnings at the beginning. So what you do is that your net asset will now be calculated as ordinary shares or share capital, which we assume that at the at the end, the share capital at the beginning is the same as the end. There's no additional issue. So we look at the retained earnings. The retained earnings at the time of acquisition. Retained earnings at the time of acquisition. Retained earnings at the time of acquisition. If you have any capital surplus at the acquisition date, you add capital surplus. That will give you your net asset using the equity side. If you have other components of equity, you add that one. These are all at acquisition. This is the net asset at acquisition. But IFRS 13 fair value measurement is saying that at the date of acquisition, all the assets and liabilities of the subsidiary should be measured at what? Fair value. So in the question, they can say that there was an asset which cost 12,000, is now 13,000. What is happening? It means that it has increased by 1,000, isn't it? It has increased by 1,000, isn't it?
Yes, sir.
What will be the effect of that? What will be the effect of this on the net assets at acquisition? What will be the effect on the net asset at acquisition? Are we going to add all the 13,000, or how much are we going to add? How much are we going to add? Eva, how much are we adding?
Hello, sir.
Yes.
Which one are we calculating now? I got up, so I just came back.
Okay, we are looking at the value of the equity shares, value of the shareholders fund at the date of acquisition.
Okay.
Okay. So we are saying that basically we should have the assets minus liabilities. But for the assets, what normally happens is that the asset that you will be giving the exam will be asset at the end. So it means that the subsidiary can acquire another asset after acquisition. So we can't use that value as the asset at the date of acquisition. They can also incur another liabilities during the year, which is after acquisition. So if you're using the asset minus liability, you might be getting a wrong figure. So we use the equity side where we look at the share capital at the beginning, at the date of acquisition, retained earnings, capital surplus, other component of equity. And I'm saying that IFRS 13, which is share value measurement, says that at the date of acquisition, all the assets and liabilities of the subsidiary should be measured at fair value. That means that at the date of acquisition, some of the value of the assets and liabilities of the subsidiary will change. Some of the value will change. So I'm saying that at the date of acquisition, they are saying that there is one plant which is included in the property, plant, and equipment of the subsidiary, which has a fair value, which has a carrying value of 12,000, now has 13,000 as a fair value at the date of acquisition. So I'm saying that what are we going to do? Are we going to add all the 13,000 to the share, to the net asset at the acquisition, or we are going to add how much?
We are
going to add how much?
We are going to add. So the difference will be 1,000.
So is it a different? Is it 1,000 that we are going to add, or
Yes,
we add what? Hey,
yes, I think.
You think what?
Please, I don't have any idea.
Oh, you told me last time that you don't have problem with consolidation. Okay, maybe it's the way that I'm asking the question. Is it the 12,000? That is the count. That is the carrying value. It's already factored in the financial statement. So the 12,000 is already.
We are going to add 1,000.
Yes, we are going to add 1,000 because the 12,000. We are going to add 1,000 because the 12,000 is already part of this one. It's already included in the calculation of the net assets. It's already been in the financial statement. So it's 1,000 that is not there. So it's 1,000 that we are going to add, which is the increment. So at that date, you look for the fair value adjustments. So there will be a fair value adjustment. Then you look at them. So fair value adjustment can be upwards, it can be downwards. It can be upwards, it can be downwards. But you have to be mindful that some of the assets will have a useful life. Therefore, we have to depreciate. Okay, ni ama.
So are we doing consolidation or what?
Yes, we are doing group accounts. Consolidation is a group account.
Okay.
You just join, isn't it?
Yeah.
Don't worry, the recording will be there. All my these things are recording. All my lectures are recorded, so that people who are not parts, you will not be left out. All right. But I hope that those who join the class, those who did consolidation before, you can see that there are some things that you don't learn that you have to learn. It's very necessary. Don't worry, it's very necessary. So this is how we look at the value of the assets, value of the subsidiary at the date of acquisition. Then you compare with the amount that you are paying. You compare with the amount that you are paying. You compare with the amount that you are paying. If you are paying more, then the excess will be seen as a goodwill. If you are paying less, you have to recalculate your net asset again. If still, okay, Eva.
Okay, you see, so the reason why I'm confused is that are we doing the net asset schedule? Is it a net asset schedule?
It's not a net asset schedule. We are just trying to calculate the value of the asset at value of the subsidiary at acquisition, which is the same as a net asset schedule.
Okay.
All right. You're preparing the net asset. Okay.
There is one that they'll do at reporting, at acquisition, then post acquisition. What happened to that one?
That one you are doing it because basically you want to know the profit made during the year. So the post acquisition is a profit. But me, I can tell you that if you have time, if you don't have time, just what you have to do is that just look for, because the net asset at acquisition is very important, because you have to use it to calculate a goodwill. You have to use it to calculate a goodwill. So you can determine the net asset at acquisition. Use it to calculate your goodwill. But your post-acquisition thing that you're talking about, which is at acquisition, at reporting, you can ignore it. Then you go and take the profit of the subsidiary for the year. Then anything that will be post-acquisition adjustment, which will be the depreciation, excess depreciation, and those things, adjust it to that profit. Then you share the profit. You are going to get the same thing as if you are doing the net asset table. But don't worry, in any case, we are going to do that too. I'll do a net asset table for you, and I'll do the one that I'm talking about. You pick the one that you like.
Okay.
All right. All right.
They will say.
Okay. So basically, this is how we calculate the value of the company, which is relating to the ordinary shares. So if assuming that at the end of the day, we are having 150,000 as a value, this is the full value of the shares, isn't it? This is the full value of the share, which is 150. But we are buying only 70%. We are buying only 70%. And they are saying that the 30% that we are not buying, the 30% that we are not buying, the 30% that we are not buying is 30 million. The total value that we have gotten is 50 million. But they say the one that we are not buying is 30 million. What is the portion that we are buying? What is the value of the portion that we are buying? What is the value of the portion that we are buying? The total value of the company is 150. We are buying 70. And they say that the 30% that we are not buying, the value is 30. The value is 30 million. What is the value of the portion that we are buying? Dennis?
120.
That would be 120. How did you get a 120? You subtract the 30 from 150, isn't it?
Yes, or you multiply the 70 by the 150.
It will give us the same thing, isn't it?
Yeah.
Oh, that is a coincidence. That is actually a coincidence. All right. That is actually a coincidence. We have two ways of calculating a goodwill. It can be a partial, it can be a full. So I'm assuming that it's a full. So let's assume that the cash consideration that we are paying, we are paying 135 million. What is happening? What is happening? Dennis, what is happening?
I think yeah, we are paying more than the consideration
By how much?
by 5 million. Yeah, 5 million.
No. What we're supposed to pay is 120. Yeah. Ever.
I beg,
Okay,
say,
that's 50,
please,
50 million.
did
Yeah.
Dennis say that you multiply the
Is
when
that
he asked what would be the percentage that he said 120,
yes?
and you asked if he subtracted the 30 from the 150 to get the 120,
Yes.
but he said something.
He said we can also multiply the 70. And I'm saying that is it the same thing? If that is it, there is a
70
coincidence.
by what? 70 by what? Because
By
you're
the,
not getting
by the
it.
150. But if you do that, you will get, if you
You
multiply,
get 105.
yes. So I'm asking,
0.7 by 150.
yes. So I'm asking if that will give you the same 120. And he said yes. And I said that might be a coincidence because we have two ways of
Yeah.
valuing goodwill.
I think I'm wrong. I was just looking at face value, thinking
Okay.
that.
Okay,
Yeah,
okay,
sorry for
okay.
that.
So if you multiply it, it will not give you that figure. So it means that
That
we are
will give
using,
you 105.
so it means that in this case, we are using a full goodwill. We are going to look at how we calculate goodwill. So you can see that we are paying 15 more, isn't it? 15 more, isn't it? And that 15 more will be seen as a value of the 70%, value of the 70%. So that 15 more that you are paying is the goodwill we are talking about.
Hello, sir.
Yeah.
I think it's better if we speak to the figures as we have arranged them. If
Okay.
we are paying 130, meaning we are paying 30 more.
Okay. Okay.
Yeah, that will be it.
So this is the NCI.
the-
This is the
yeah.
total value of the company. Let me just name them so that it will be okay. Total value of the SAP. Okay. So this is the total value, isn't it? 150 is the total value. We are buying 70, but they are saying that the portion that we are not buying, which is a 30%, which is a 30%, is 30 million. Are you getting it? So the 100% is the 150. We are buying 70, but they are saying that the 30 that we are not buying is 30 million. So what portion are we buying? We just subtract the portion that we are not buying from the total value, which will give us 120. Are we there?
Yes.
Okay. But the amount that we paid is what? 135. So how much do we pay in excess?
15.
15. So goodwill is basically calculated as consideration minus the value that we are buying. The value that we are buying. But some people can also calculate the goodwill like this. They will say cash consideration, which is 135. Then they will add the NCI. They will add the NCI, which is 30, isn't it?
Mm-hmm.
They will come and subtract the net assets. They will come and subtract the net assets. Then after subtracting the net assets, which is 150, what will be the value? It will be 15, isn't it? Okay, so the goodwill will be what? Okay, Niyama.
So please, how did you get the 135?
135, you just assume that is the cash consideration that we are paying.
So assuming.
It's an assumed figure that is the cash consideration that we are paying. It just this is just illustration that we are doing. We haven't started solving the question.
Okay.
Okay. So I'm saying that some people, they can also calculate the goodwill like this. Those who have written FR before, you normally see that you are adding the NCI to the cash consideration. Are you getting it? Before you come and subtract the total value of the company. Is that not what we normally do? Eva, is that not what you normally do?
Yes, please. Yeah.
Yes, I think there is a proportionate method,
Okay.
and then there's a fair value method.
So this
So
one we are
it
using.
could be what you are using. The first one is the proportionate method, and the other one is the fair value method. The
No.
one you are adding, the NCA, and then the net asset at acquisition is the fair value method.
No, what I'm doing is still the fair value method. I haven't started
the proportionate. Yes.
The proportionate.
Yes.
I'm still using the fair value method because you can see that the value that I've subtracted is the fair value of the NCA that I've subtracted from the total assets, which is the 30. But if I should apply 30% on the 150 and subtract it, then that would be the proportionate method.
The proportionate.
So the proportionate method, what we normally do is that we use the percentage on the total value of the assets. We use the percentage. But what I'm doing over here is still the fair value method. But do you know why you normally add the NCI to the cash consideration? Do you know why? Because the NCI is part of the net assets. The 30 is part of the net assets. So if you want to use all the net asset, then it means that you have to increase the cash consideration by the 30. So that if you subtract the 30 from the 30, it will have a negative effect of 0. Is my video on? No, my video is not on. Okay, you want, let me try and see whose video is on. So that
the lady's video was on.
Okay. It's now off, isn't it? It's now off. All right. Okay, so I'm saying that you can just go ahead and look at the NCF value given to you in the question. Subtract the NCF value from the total net assets at acquisition. Then you take that value. That value will now be the portion that the parent is buying. You compare with the cash consideration, you get your goodwill. Or you can maintain the total net asset. Then you come and add the goodwill to the cash consideration. Then you subtract the total net asset. You are doing this because the 30, which is the NCI, is already part of the net assets. So you should have subtracted it before, but you haven't done that. So go and increase the cash consideration so that if the 30 you added to the cash consideration and that 30 part as part of the net asset, if you do it, it will have a negative effect. The two will cancel. The two will cancel. So anyhow you do it, you're on the same, you are going to get the same figure. So that is basically we calculate the net asset. Net asset, you can do it at acquisition or at reporting. We are going to take a question, then we look at how we do that. Okay, I even have this one over here. So you can see that at acquisition, they will give you the values, these values. But ordinary share capital, we assume that the value at acquisition is the same as the value at reporting. There is no issue of additional shares. So you go to the financial statement, you take your ordinary share capital for the subsidiary, then you put it the same figure for acquisition, the same figure for reporting. Then the share premium, there will be a share premium figure in the statement of financial position for the year, but they will also give you additional information. Maybe the footnote 1 will give you information about the share premium that was there at the date of acquisition. So the one that was there at the date of acquisition will be the one that will come here. So the one in the financial statement will be the one at reporting, which will bring here. Retained earnings, they will give you information on the one at acquisition, the one at reporting. So you bring the one at acquisition over here, then the one at reporting, which is in the financial statement, will come here. Then you come to the revaluation surplus, they'll give you the same information, which is one at acquisition, the one at reporting. So let's move on. Other components of equity, they will give you information over there, which will be one at acquisition, one at reporting. You bring the figure there. Goodwill in the books of the subsidiary. Goodwill in the books of the subsidiary. Maybe at acquisition, there can be some kind of goodwill in the subsidiary. You have to send them over here. The figure at acquisition, the figure at reporting. Let's come to fair value adjustments, which we did 1. So at the date of acquisition, the parent has to value all the liabilities and assets of the subsidiary at a fair value. So there will be a fair value loss, there will be a fair value gain. So you bring them over here. You just bring them the excess because the current value has already been factored in the net asset. So it is the excess, it is the additional figure that were not incorporated in the financial statement. So it is the additional figures that will come. So I was saying that there can be a plant which have a useful life and those kind of things. Those depreciation and amortization of those things, it will be issued at reporting. It will be issued at reporting. Don't worry, we take them and we look at them. We take them and we look at them. All right. So some people will do this and have post-acquisition profits. There is no problem with that. Okay. There can also be a situation where you have issue about deferred tax. You have issue about deferred tax. I wanted to say this when we are doing IS12 income taxes, but I'll say it over here again. You see, no, let me just say it in the income tax so that we relate it to this one. I'll say it in the income tax because some people, they haven't heard about IS12 before, they haven't done it before. Whatever I'm planning to say over here, they will be confused. So the fair value measurement, the net asset of the subsidiary usually measured at fair value upon consolidation. Any fair value adjustment to the carrying value of the element of the net asset must be included in the net asset table talked about earlier, which is the first one. The consequential effect of fair value adjustment must be determined and treated in both either income statement and statement of financial position appropriately. So in the question, they can say that the fair value, which is 1,000 over there, this might be relating to a plant. And they say the plant has a remaining useful life of 5 years at the date of acquisition. Let's assume that this will be a full year acquisition. This will be a full year acquisition. So if the acquisition is done on 2020 January, 2020 December, that will be a 1 year. Are you getting it? If it is a 1 year, would the value of that plant still be 1,000? Would the value of that plant still be 1,000? Would the value of that plant still be 1,000 ever? The additional value was 1,000 at the beginning. And at the end of the year, would that value still be 1,000? Ever, would that value still be 1,000?
The value was 1,000.
At the beginning. And they say that the plant has a useful life of 5 years.
Okay.
Would that
For
value
5
still
years.
be?
So it will be 1,000 divided by 5.
Okay. Eric
No,
is saying
it won't be.
Will it still be 1,000 at the end?
No, it won't be 1,000 at the end. It will be 800.
It will be 800, isn't it? That
Yes,
means
please.
that we have used 1 year, remaining 4 years, isn't it?
Yes, please.
So we are going to have a depreciation of what? 200,
200.
which is
Yes.
1,000 over 5. But we didn't,
Yes,
we didn't send the financial statement given to us. The 1,000 fair value adjustment was not incorporated in the financial statement. Therefore, the depreciation to which is 200 is not also incorporated. But if you are coming to add the 1,000 to the value in the statement now, it means that the depreciation must also be taken care of, isn't it? So you have to supply the depreciation from
Yes.
the post-acquisition profits of the subsidiary. That is why you have fair value depreciation and amortization at reporting. This will always be done at reporting because at acquisition, the value is still the same. You haven't used the asset. It is at reporting that we know the number of months that you have used the asset, the number of years that we have used the asset. That is why we have the fair value depreciation over there, which will be subtracted from the post-acquisition profits of the subsidiary. Don't worry, we'll be okay there when we come to a question. So what we are going to look at is that forget about the provision for unrealized profit. We are coming to look at intra-group trading. Intra-group trading. We are coming to look at intra-group what? Trading. Intra-group transactions. Intra-group transactions or intra-group, yes, intra-group transactions. Intra-group transactions. Intra-group transactions. And the first one is intra-group trading. Intra-group trading. Intragroup trading. What do we mean by intragroup trading? What do you mean by intragroup trading? What do you mean by intragroup trading? Eva, what do you mean by intragroup trading? Eva, what do you mean by intragroup trading? Eva, are you there? Dennis, what do you mean by intragroup trading? Philip, are you here? Okay, Niyama, what do you mean by intragroup trading?
Intra. So that means trading among the subsidiaries within the organization.
Okay, trading among the parents and other what?
The one that has been purchased.
Okay, so it can just be the parents selling to the subsidiary or the subsidiary selling to the what? To the parents. There's a trading activities within the group. Philip, are you still here?
Yes, please, sir.
Are you sure?
Yes, sir.
Oh, Charlie, you are now a ghost in this class. Or what happened? Are you on top of issues? Are you seeing top?
Yes, please. Yes, please. I'm following.
Okay, you are following because what you learn this the same way I was also lost in the class when they are doing this group account because what I was trying to relate what I learned at first degree to what they are teaching, and I realized that no, my sister, my brother, I'm not on top of issues, so I just have to forget about them and this one. So if they say intra-group trading, basically what we are saying is that there is a normal business activity going on within the group. Either the parents selling to the subsidiary or the subsidiary selling to the what? To the parents. Are we there? Are we there? So if the parent is selling to the subsidiary, one thing that you have to know is that the parent is not selling to the subsidiary as in the subsidiary in itself. The parent is not selling to the subsidiary as in the subsidiary in itself. But what is happening is that the parent is selling to the public through the what? The subsidiary. Are you okay with that statement, or I should take it again? Dennis, should I take that statement again?
Yes, sir.
Okay, I'm saying that if the parent is selling to the subsidiary, it is not as if the subsidiary is buying from the parents and will resell it at a profit to the public. No, the parent is selling to the public through the subsidiary. I will explain that. If we have a company in Ghana here, and the company wants to sell to the market in Nigeria, we don't have the resources to go and establish, to go and build and do things there. So we just go there and acquire a company that is already operating in Nigeria. So what are we going to do? We are going to sell to the Nigerian market through our subsidiary over there. So we just send the goods to the subsidiary that they should sell it to what? To the customers in Nigeria. So what will happen is that this subsidiary are selling these goods on our behalf. So we just give them the selling price that, okay, sell it at this amount. That is the amount that they will sell it and remit the money that they have realized to us. That's how they are going to do. It's just that you are selling iPhones and you have a friend. You say that, oh, Charlie, can you help me sell these phones? Can you help me sell these phones? Okay, the iPhone 11 is 7,000. Your friend will not go and add 500 to it and be selling it 7,500 because you are not selling to him and like he's not buying from you and resell. You are just selling to people through him. The only thing that he can get is commission. Are you getting it? The only thing that he can get is commission. He's not going to sell at a price different from the price that you are giving to him. It's just like you have a branch, you have the head office in Accra here, you have a branch in Kumasi. If you send the goods to the branch will not go and determine their own selling price. You give them the price that they will sell the goods. The only thing that they will do is that they will sell and remit the what? The money to you. But in the individual separate financial statement, the branch will assume that he's buying the goods from you and reselling it. They will buy at the same price and sell at the same price. They are making a zero profit. And you also assume that you are selling to the branch. So you also recognize what? Sell in your books. But if you are coming together, you have to know that there is no sales. You can't sell to your own company. You can't sell to your own company. So when there is an intra-group sales, when all the goods are being sold, it means that we don't have any issue of the profit that will not be what realized. But if there are some goods left, all the goods are not sold, there's issue that the profit that the parent has entered in its own financial statement or separate financial statement will not be realized if you're preparing one account as a group account. Let's take this particular example. There was a sales of 1,000 Ghana cedis from the parents, and the cost price of this, was 600. It means that the parent is making a profit of what? It means that the parent is making a profit of what? 400, isn't it?
Yes, sir.
Okay, so in the books of the parents, how the parent is going to record this? The parent is going to have a revenue. The parent is going to have a revenue of what? The parent is going to have a revenue of 1,000, isn't it? And cost of sales of what? 600. Are we there? And the parent will be having a profit of what?
400.
400. Let me put 1,000 here. Let me put 600 here. So the profit will be 400. Are we okay there? Are we okay there?
Yes, sir.
Habakkuk,
Yes, sir.
answer ever in the group that the class is not over. I don't know whether she's sending the message to me directly or
Okay.
I don't know whether it is in the group. Okay, it's direct message. So let me
Okay.
let me reply. All right. Okay. So the parents will be making a profit of about 400, isn't it? All right. What in the books of the subsidiary, what will happen? The subsidiary will take these goods from the parents. The subsidiary will take these goods from the parents. And let's assume that the subsidiary sold only 800 of these goods. So the subsidiary will have revenue of what? 800, isn't it? And the cost of sales will also be what? What will be the cost of sales? The subsidiary sold only 800 of these goods. So subsidiary will recognize a revenue of 800. What will be the cost of sales? Dennis, what will be the cost of sales for the subsidiary?
Will be
If you
I
say
think
this,
200.
if you say this thing, then we end the class. If you should measure this, if you should mention this answer correctly right now, we just end the class over here. If you give goods worth 1,000 Ghana cedis to your friend to sell, and your friend sold 800, what will be the cost of the sale for your friend? Dennis, what will be the cost of the sale to your friend? You gave goods or you gave iPhone to your friend, which is worth 1,000 Ghana cedis. At the end of the day, he sold 800. What will be the cost of the sale? What will be the cost of the sale?
I'm a bit confused here.
Okay. Okay. Habakkuk, do you have the answer?
So I'm not sure, but I'll just try.
Okay, try.
800.
It's 800. Your friend will not make any profit on the sale. So the cost is the same as the revenue. There's no profit. Dennis, are you there?
Yeah, got it.
Yes, the subsidiary will not make any profit because they are not buying to resell. It is the parent that is selling through them. So the cost of the goods becomes the price of the goods given to them. So if the goods given to them is 100,000 at the selling price, they are not going to make any profit from it. They will just sell the goods and send the money back to the parents. So your friend will just sell the iPhones and send the money back to you. So in any sale that your friend is going to make, he's not going to make any profits. So the selling price of the goods becomes the cost price for the subsidiary, and that will also be for your friend. So this will also be what? 800. The subsidiary is making a profit of what? 0. You can't be selling to your own branch. You just sell the good, you send the goods to a branch, and you call the branch manager that, okay, these goods, they should sell it at 100,000. So the branch will sell it and send the money back to what? To the head office. They can only sell and make profit on the goods that they bought themselves, the goods that they bought from outsiders themselves, goods that they bought from external sources. That is the only thing that they will do. That is the only goods that they can sell and make profit. But the one that you are giving to them is that one that they will sell on your behalf. So the selling price becomes the cost price to them. They will not make any profit. Dennis, are you okay?
Yes, sir.
Okay. So you can see that the 100,000, the 1,000 worth of goods were not sold. The only portion that was sold was what? 800, isn't it? The only portion that was sold was what? 800. So there will be a portion that the profit on it will not be what? Will not be achieved. Okay. So if you're preparing consolidated financial statements, this is how the consolidated financial statement will look like. We are going to take the 1,000, which is the revenue for the parents. We add the 800 to it, isn't it? Then we take the cost of sales. We take the cost of sales, which is what? 600 for the parents plus 400 plus 800 for the what? Plus 800 for the what? For the subsidiary. So in all, we are going to have 1,008 minus what? 1,004. This will be a profit of what? 400. This is when all the goods have been sold, isn't it? If all the goods have been sold, this is the profit that we are going to make, isn't it? Dennis, is that not the case? If all the goods have been sold, the profit will be 400. But were all the goods being sold by the subsidiary?
No.
So what value of the goods were sold?
Value not sold is 200.
So the value sold is what?
800.
Okay, look at this. The 800 and 800 here, you know that they will cancel off, isn't it? The 800 in the revenue and the 800 in the cost of sales will cancel off, isn't it?
Yes.
Okay, so what will happen is that the actual sales made should have been what? 800. So you come here and subtract the portion of the goods that is not sold from the revenue, which is 200. 200 was not sold. Are you getting it? 200 was not sold. So we take the parent is recognized all the 1,000, but 200 was not sold. So we have to come and subtract the 200 from the 1,000 so that we have the 800 for the parents. Do you get the agreement? Because we assume that the 800 and 800 over here will cancel off. Okay, so if all the goods were not sold, will all the costs be 600? Will all the costs be 600? So the 800 that were not sold will also go with what? The cost of sales, the cost of the goods. The 200 that were not sold, it will also go with the cost, isn't it? Therefore, the cost should not have been what? 600. So you have to determine the cost of the unsold goods. The cost of the unsold goods. The cost of unsold goods, how we determine it, we use the profit element to determine the cost of the unsold goods. So what is the total profit? What is the total profit? The total profit was 400, isn't it? What is the total profit? Was not 400?
Yes, sir.
Okay, if it is
400, yes.
Okay, it is 400. What worth of goods are we selling together? 400 is 1,000, isn't it?
Yes, sir.
So if we sold 800, it means that 200 were not sold. So for you to get a profit on the 200 that were not sold, we do it like this. 200 over the total, which is 1,000, times the profit, which is what? 400. What is the figure? What is the figure that you have gotten? 200 over 1,000 times 400. What is the figure there?
That's 80.
80. So that is the profit, isn't it? That is the profit on the 200 that were not sold. That is the profit. That becomes the profit which were not realized. But the selling price for the goods is what? 200. So what will be the cost price? What will then now be cost price? The selling price is 200. The profit on that particular 200 is 80. What would now be the selling price? What will now be the cost price rather? Cost price will now
280.
Cost price will now be what?
200.
280.
No, it cannot be 280. Selling price is 200. Profit is 80. Cost price is now what?
200.
No, cost price cannot be 200.
180.
Cannot be 180.
Yeah.
How do we find cost price? Cost price is equal to selling price minus profit, isn't it?
Yes, sir.
Yes, sir.
So what will be the cost price?
120.
120. 120.
120.
The selling price is 200. The profit is what? 120. So it means that the 600, this 600 is for the 1,000. So since we are not able to sell all, the 120 will not be part of the 600 again. The 120 will not be part of the 600 again. The 120 will not be part of the 600 again. So what we do is that we now bring this one down to this one. Then this will now be, what will be the figure now for this one? 600 plus 800 is what? 1,004 minus 120 will give us 1,280. 1,280. So let's subtract this minus this. The profit will now be what? 320. That is the actual profit. You can also calculate this actual profit by like this. 800, which is the value of the goods sold, divided by total value of the goods to be sold, which is 1,000 times 400. You get the what? The 320. You get a 320. You get a 320. That is another way of doing it. Okay, let's count to this adjustment. You can see that the only adjustment that we did for the figure was 200 and 120, isn't it? All right. Let's count to 200 and 120. 200 and 120, what is the difference? 200 and 120, what is the difference? 80, isn't it?
Yes, sir.
So we can just eliminate the 200 over here, and we also eliminate this one over here. Then we come and add only 80, which is a profit element. It means that 120 is already part of the 600. Then if you add 80, you make it 200. The 200 over here will cancel the 200 over here, which is supposed to subtract. That is also another way of doing it. So we have 1480. Then we have 320. Very simple. So what you have to know is that upon consolidation, the subsidiary sale becomes the actual sale for the group. The subsidiary sale becomes the actual sale for the group. The subsidiary sale becomes the actual sale for the group. The subsidiary sale becomes the actual sale for the group. I've said that like 3 times. All right. But this is just my own point of dealing with. This is just my own point of dealing with the unrealized profits. But what does the standard say? The standard says that we should assume that there is no sales. In actual sense, the parent cannot sell to the what? To the subsidiary. The parent cannot sell to the what? To the subsidiary. So in actual sense, there is no what? Sales. There is no sales. There is no sales. So if this is the case, then let's come here. This is the sales. This is the individual financial statement. So if you are consolidating, we add the revenue of the parent to the revenue of the subsidiary, which is 1,000 plus 800. Cost of sales, we add 600 plus 800, which becomes the cost of sales for both of them. Are we there? Okay. So if you assume that there is no sales, what will happen? The parent is not selling to the what? To the subsidiary. The parent is not selling to the what? to the subsidiary. So we cancel the sale of the parent to the subsidiary, which is 1,000. So the parent is actually not selling to the subsidiary. So we cancel that. We cancel that. If you come here, the assumption is that the selling price of the goods becomes the cost price to the what? To the subsidiary. So we subtract all the what? All the 1,000. All the 1,000. All the 1,000. We subtract all the 1,000. Are we there? Okay, let me make this simple so that we all understand. Let me come here and say the cost of sales is 1,000 minus 200. The cost of sales is 1,000 minus 200. Do you know why I say 1,000 minus 200?
Yes, sir.
Do you know why I say 1,000 minus 200? The cost of sales for the subsidiary. Because the parent will sell to the subsidiary at 1,000. 1,000 now is the cost. But the subsidiary was able to sell only 800. So the subsidiary will be left with 200 worth of goods. So the cost of sales will now be the purchases minus the closing stock, which is 1,000 minus 200. All right. So let me come here. Let me also put the 1,000 minus 200 over here. So we are removing this one. Then we have the 1,000. 1,000. Are we there? Are we
Yes,
following?
sir.
All right.
Yes.
So you can see that when there is no sales, this 1,000 will cancel the 1,000. So we are going to have only 800 over here, which is the actual sales for the group. So the actual sales for the group is now the sale for the subsidiary. So if you are canceling this 1,000, we are going to have 800. Are we getting it? Let's come here. This 1,000 will cancel the 1,000. This 1,000 will cancel the 1,000. So it should have been 600 minus what? The cost of the goods. But this one, we are taking the selling price of the goods, which is the 200. The 200 is now the selling price of the goods. But inventory, IS2 is saying that inventory should be measured at lower of cost and net what? Realizable value. The cost is 120. The cost is 120. The cost is 120. But the net realizable value is 200. We can't take 200. We have to take the 120. So what do we do to make sure that the 200 over here becomes 120? What do we do? What do we do to make the 200 over here becomes what? 120. What do we do? Habakkuk, what do we do? Habakkuk, what do we do to make the 200 over here becomes 120? Habakkuk, what do we do to make the 200 over there becomes 120? Habakkuk, can you hear me? Okay, Eric is saying that we subtract what? 80. But this one over here, this 200 over here is already negative. So we just come and add 80. We just come and add 80 to it. So that this will now become 420. So 420, we still have our profit of this will now be 200. This and this will go. Now this will now become, this will give us 400. Okay, this will now be 480. Okay, so we have a profit of 320 again. That is it. So this is what the standard recommended. And all of you that have written FR before, this is what you normally do. So when there is an intragroup sales, the standard says that remove the intragroup sales, assume that there is no sales. This is because the parent cannot actually sell to itself. The subsidiary is part of the parent. So there's no way you can sell to yourself. So remove it. So remove it. Then what we do is that we just find the unrealized profit element. Then we come and add it to the cost of sales. If you're adding it to cost of sales, it means that the selling price of the goods that the subsidiary has subtracted as closing stock. If you add it, that means you are reducing it to the cost, the actual cost of the goods. That is why we add the 80 to make it 120. That's what we do. So if they have a question on intragroup sales, look at the portion or the sale that relate to the parents or the sale that relate to the subsidiary. The value of the goods that they are selling the selling price, subtract it from the revenue, and subtract it from the cost of sales. We are removing the sales because the parent cannot sell to itself. The parent cannot sell to itself. So remove it. Then what you do is that the subsidiary or the parent has subtracted the selling price as closing stock. You have to subtract cost price. So find the unrealized profit, add it to the cost of sales. If you're adding it to cost of sales, it means that you are reducing the selling price now to a cost price, which should have been subtracted from the actual cost of sales. That is the issue. That is how we go about the. If someone is saying that PSA class has started. So since PSA class has started, I will just end it over here. But let me talk about the effect of this one. The effect of this one. You see the 200 that the subsidiary is taking as the 200 that subsidiary is taking as closing stock. Where can we find the 200? Which financial statement? Which statement can we find the 200? Which statement can we find the 200? Which statement? Is it profit or loss of statement of financial position? Where can we send it? The closing stock that the subsidiary is taking. Where can we find it? Is it balance sheet or profit or loss account? Yeah.
Balance sheet.
Okay. What should have been the actual value for this particular thing? What should have been the actual value for? This is a selling price, isn't it?
Yes, sir.
The inventory should actually should be carried at cost. Should be carried at cost. So the cost should have been 120, but the subsidiary is carrying this at 120. So what are we going to do to the inventory in the statement of financial position? What are we going to do? What are we going to do?
We are going to add the difference.
You are going to add or subtract. It should have been 120, but you are writing 200. So you have to go and reduce it to 120.
Yeah.
So that is why we normally go and subtract the provision for unrealized profit from the inventory to make it what's the cost now, which is 120. So when there is this one, calculate the unrealized profit, add it to cost of sales, subtract the actual sales, either if it's the parent selling or the subsidiary selling, the value that they are selling, subtract it from both revenue and cost of sales. Calculate your profit from unrealized profit, go and add it to cost of sales. Then that particular value should be subtracted from the inventory in the statement of financial position. It means that the subsidiary or the parent is carrying the inventory at selling price, which should have been at cost price. So you go and subtract the unrealized profit element from it to reduce it to what? To cost price. To cost price. That is basically about the provision for unrealized profits, which is intragroup trading. We're also going to look at intragroup transactions, which we have many of them. So next week, Saturday, we continue with intragroup transactions. Intragroup transactions. The first one is intragroup trading. Intragroup trading, what we do, if it is profit or loss, this is what we do. Don't worry, we pick a question, you will be okay. Then we look at where there will be a transfer or PPE. The parent or the subsidiary will sell a PPE to one of the group. The parent can also acquire some of the loan notes. The parent can acquire the preference shares. We are going to look at all those transactions. And maybe at the beginning of May, we should start solving questions on group accounts. Because next week we look at the issues again. Then if you are okay with all of them, then at the beginning, first week in May, we should start solving questions. We solve about 4 questions. Then we are done. Then this night we are doing ratio analysis. 5 p.m. we are doing ratio analysis. All right. So those people who have the PSA, you can now leave and go to your PSA class. Those people who just joined, the recording will be on the Telegram page. So you can go and listen to it. But before I end the meeting, do you have any question? Philip, do you have any question? You're going. I know.
No.
Do you have any question? You don't
Okay.
even know, you don't even know what you are doing, so there's no question. Those who have done consolidated financial statement before are the people who ask the question. Yeah, Francis.
Okay.
Francis, you just joined. Francis, you just joined. Do you have any question? No, you just joined. You don't have any question. Christiana, you joined not too long ago. Do you have any question? Christiana, do you have any question? Silo, do you have any question? Infinite 08. Do you have any question? Habakkuk, Eva, Claudia, SS. Do you have any question? Or we are going to be okay when we start solving questions. Are we there? All right.
Yeah, I think so. I think in our next meeting we can still go over these intra-group transactions again. Maybe
The intergroup trading.
yeah. Yes, please.
Okay. So right now, okay, right now you have come to understand why you have been subtracting these things and be adding them.
Yeah, I it's quite familiar, but then I think I'm just getting confused. Maybe the approach you are using. Normally they use this percentage wise.
Okay. So don't worry, we will use a percentage next one. But
yeah.
it is not always the same that they will give you.
Exactly. So if it's so, then I prefer maybe next week we go over this again so that it can sync well with us.
Okay. It is not always that they will give you the percentage. They can give you the cost price. They can give you the selling price. You have to find the profit element. Then the profit element, you have to use you normally use the selling price to determine the profit element. That is why you can see that I've used the 200, which is the selling price, and also the 800, which is the selling price over the actual selling price to find the profit element. So I'll go over it again. Then next time we use the percentage.
All right.
Percentage. All right.
Thank you very much.
Okay. For corporate reporting, they don't give the percentage. Sometimes they don't give the percentage. And next week, we are going to look at when the goods are being transferred to the subsidiary at a loss. What will happen? When the goods are being supplied to the subsidiary at a loss, what will happen? Or if the subsidiary supply the goods to the parent at a loss. All the question that you have been seeing is at profit, isn't it, Dennis?
Yeah, exactly. Yeah.
What if it is what if it is at a loss? What are you going to do? You just be there and say you haven't seen it before? No.
I will try some.
Okay, don't worry. Next Saturday we look at both the loss and the percentage portion. Are you okay then?
Okay. Yeah, thank you.
Okay, all right. So if you don't have any other question again, Silo, are you okay? Silo, are you okay?
I'll have to go through again. I'll go through the video again and I'll get back with my questions. Thank you.
All right. Niyama, you're okay. You are the one sending me the questions, so you there, you have to be okay. Let's
say I'm not okay. Oh. It's new to me, sir.
So you haven't done FR before?
No, sir.
Okay, don't worry. If we start solving questions, you'll be okay. You'll be okay. But you have done branch accounting before.
Branch accounting, that was SS.
Oh, sorry. It's too long. But don't worry, we take it again, then I'll use question again. Then we'll be okay. All right. So if there is no question, yes, those who don't have my calculator, you don't know the secret of having my calculator. You see, if you have a calculator, you are okay with the standards. You are on top of issues already. Yes, you are going to be on top of the standards. There's no standard that you see in the exam that you can't do. You can go and ask people. The calculator will give you that spirit of knowing the standards. The calculator will give you that spirit of knowing the consolidated financial statement. Since you know the standards, you are okay with the final accounts, and you're okay with the ratio, and you are going to pass the exam. So people, you are there. Yeah. You are there. Yes.
But sorry, I'm quite a bit. I want to be inquisitive.
Okay.
Your calculator, is it a customized one or what? Because I also have a calculator.
It's a normal.
I don't know how special it is.
It's a normal calculator, but I've set it for half hour. That I've done some listings on it. So if I'm saying that it's not a customized one, but I'm talking about spiritual content over here. The one that you
okay.
have is, if you talk about the physical content, they are all the same. But if you talk
Oh,
about
okay.
the spiritual realm, my own is ahead of your own. You
All
get the
right, now I
issue.
understand. Yes,
So that is the power of having my calculator. But in
so
actual,
does it mean that those of us who have calculator, we should buy yours again?
no, since you are attending my class, you should buy. But if your own is old, you have to change it.
This is FX 991 EU S plus.
Okay. Is it a new one? Or I'm not talking about if the calculator can be that one, but it will still be old. You get it?
That is a new one. It's a
Okay.
new
Since
one.
it's a new one, then you are okay to go. I just have to factor you in my prayers. If I'm praying, I have to factor you that. Okay. So Dennis is not having calculator for me, but since he's having a new calculator, God,
Yeah.
grant him a hand. So that is it. Ni Ama, you wanted to say something.
So he has asked my question. I wanted to know which type of calculator was that.
My own, I'm not talking about it's an extraordinary calculator. But if you talk about the spiritual aspects, you see, do you know that passing the exam also has something to do with spirituality?
Very important.
So the calculator has covered you in that spiritual realm. That is what I'm talking about. But this one, if you don't have the calculator, just let me know. It's for those who don't have the calculator. All right.
Don't joke, careful.
No, it's for those who. But I'll try my best to make sure that you are okay with you're okay with every information that you're supposed to have before you go to the exam hall. So I'll try that for the console. You are not lacking with anything. You are able to solve as more questions as we can. And the final account will be solved about maybe 5 questions. Then ratio, we do something, and Charlie, if you put in your small efforts, then at least the 50 you can get it. The 50 you can get it. Yes. All right. So if you don't have any question, then in the evening, we meet in the evening for ratio analysis. That is 20 marks. All right. See you there.
Bye.
All right. All right, Jenny.